Saving money and investing it consistently can lead to significant wealth over time. The idea of turning small daily savings into a substantial sum is often met with skepticism, particularly from those who prioritize immediate gratification or doubt the feasibility of long-term returns. This has led to a year-long challenge to demonstrate the power of consistent, small-scale investing. The $5 a day challenge, turning small habits into big wins. Many people dream of financial freedom, yet the path to achieving it often seems daunting. The common belief is that you need a large sum of money to start investing, or that investing is only for the financially savvy. But what if I told you that even skipping your daily coffee or a few impulse buys could be your ticket to a wealthier future? Imagine this: you save just $5 a day. That's it. No fancy financial maneuvers, no huge sacrifices, just $5 instead of that daily latte, a quick takeout meal, or a new virtual item for your favorite game. You set that money aside and you invest it, with an average annual return of 10%, which, as we'll discuss, is more achievable than you might think. In 45 years, you could be looking at nearly $1.6 million. When I share this idea, people are often amazed by the potential, but then come the familiar refrains: I want to enjoy my money now, while I'm young. I don't want to be a millionaire when I'm old and gray. I want it now. And the most common one: what kind of investment actually gives those kinds of returns over the long term? These doubts are completely understandable. In a world that often prioritizes instant gratification, the idea of waiting decades for a payoff can feel counterintuitive. That's why I decided to put this theory to the ultimate test. I launched a year-long challenge to show that investing just $5 a day doesn't have to feel like a sacrifice, and it can indeed lead to real, measurable returns. I'm going to walk you through exactly how I set up these investments, and then we'll fast forward to see the results a year later. Yes, by the time you're reading this, a whole year has passed, and let's just say things went better than planned. Before we dive in, please remember, I'm not a financial advisor. I'm simply sharing the knowledge and strategies that have helped me become a millionaire investor. Step 1. Finding the right platform. Choosing the right investing platform is crucial, especially when you're starting with small, consistent contributions. For this challenge, I had a few non-negotiables. If you're thinking of embarking on a similar journey, these are the key features you'll want to prioritize. Low fees. This is a no-brainer. Every dollar eaten up by unnecessary charges is a dollar less working for you. You want to maximize your potential profits, not line the pockets of the platform. Beginner-friendly interface. While I'm comfortable navigating complex financial terms and interfaces, I know that for most beginners, a confusing platform can be a huge deterrent. We need something intuitive and easy to understand. Security. This is paramount. What's the point of investing if your money isn't safe? I needed a platform that offers robust protection, like being fully covered by the Financial Services Compensation Scheme (FSCS) in the UK, which protects up to £85,000 in case the platform fails. It's important to note this doesn't protect you from investment losses, only from the platform's insolvency. Low minimum deposits. Since this is a $5 a day challenge, the platform needs to accept very small, consistent deposits. Automatic investing feature. Let's be real, remembering to invest $5 every single day is a commitment most of us won't stick to. An automatic investing feature is essential. My boomer brain, as I like to call it, definitely needs that automation. Access to fractional shares. This is a game changer for small-scale investors. Many high-performing stocks, like Apple, can cost hundreds of dollars per share. As of August 2023, Apple is around $178 per share. With a $5 daily budget, buying a whole share isn't feasible. Fractional shares allow you to invest any amount you want, no matter how small, buying just a portion of a share. There might be other features you prioritize, but these were my non-negotiables. While there are many excellent platforms out there, I've used a lot of them over the years. And one of my favorites that ticks all these boxes is Trading 212. That's the platform I chose for this challenge. Step 2. opening and funding an account. The tax-advantaged advantage of this step is often overlooked, but it's a decision that can truly make or break your long-term results. Choosing the right type of account. And for a $5 a day challenge, this choice becomes even more critical because it determines how much of your hard-earned profits you actually get to keep. Let me explain. Let's imagine we have $2, 0 to invest, splitting it equally between two hypothetical accounts. Account A and Account B. At first glance, they look identical. Both have $1,000 invested. But here's where things get interesting. With Account A, your profits aren't entirely yours. Why? Because of the dreaded tax man. First, he takes a slice of your dividend earnings. Dividends are like rewards companies give to their shareholders. Not all companies pay them, but many do. The amount the tax man takes depends on your income. In tax bracket, the more you earn, the bigger the slice. Then, he takes even more for capital gains tax. This happens when you sell an investment for more than you paid for it. In the UK, capital gains tax is typically 10% to 20% in the US. Long-term capital gains tax rates range from 0% to 20% based on your income level. Now, what about the money in Account B? This account has special protections that shield your profits from the tax man. Everything you make here is yours to keep. That's because Account B is what's known as a tax-advantaged account. Account A, on the other hand, is just a general investing account. In my opinion, you shouldn't even consider a general investing account until you fully leverage everything a tax-advantaged account has to offer. So, how do you get one? It depends on where you live. In the UK, our tax-advantaged accounts are called stocks and shares ISA letters, individual savings accounts. Closing parenthesis. In the US, they're known as Roth IRA letters, individual retirement arrangements. Both of these special accounts come with incredible tax benefits, but they do have contribution limits. In the UK, you can contribute up to £20,000 per year into an ISA. In the US, Roth IRA contributions are capped at $7,000 each year, $8,000 if you're over 50 for 2024. For most people, these limits are more than enough to build substantial wealth while still covering living expenses. The ISA, for example, allows you to withdraw money at any time tax-free, offering great flexibility, while a general investing account isn't inherently bad. It often falls short when it comes to maximizing your money. Of course, if a tax-advantaged account isn't available where you live, you might have no other choice but to use a general investing account. For this challenge, I chose a stocks and shares ISA because when we pull money out of this box at the end of the year, we want to keep as much of it as possible. I already have an account with trading to 112, but to show you the entire process from scratch, I enlisted my son, Curtis, to take on the challenge using his account. If you'd like to set up an account and join the challenge, just head over to their website or download their app. The setup process is straightforward. The only part that might need clarification is choosing the right account type. You'll typically see options like a general investing account, a CFD account for short-term trading, which we're not using, a cash ISA, and a stocks ISA. The stocks ISA is the one you'll want to open. Once your account is set up, you can fund it. I chose an instant bank transfer and deposited £35 from my son's account, which covers £5 a day for 7 days. You don't have to deposit a whole week's worth in one go. This was just my preference. And yes, the title says $5 a day, but I'm in the UK, so I put in £5, which is actually a little bit more than $5 United States dollars. Step 3. Picking your investments. The power of index funds. This is where many people make a common mistake, assuming that once money is in the account, it automatically grows. Let me be very clear. This box, your account, only protects your money from tax. It doesn't actually invest it for you. That's why step 3 is all about deciding what actually goes into the box. You could fill it with individual stocks, companies like Amazon, Meta, Apple, Tesla, or Nvidia. While these are certainly great companies, putting all your money into a handful of individual stocks can be really risky. If just one of those companies doesn't perform well, it could drag down your entire portfolio. your money is tied up in a few places, increasing your risk exposure. That's why, for this challenge, I used a different strategy, and you might have guessed it already: index fund investing. This gives us exposure to hundreds, if not thousands, of different companies without all the stress of picking individual stocks and praying for a winner. Index funds can hold shares from hundreds, sometimes even thousands, of different companies at once. This makes it incredibly easy to invest in a whole bunch of companies simultaneously, making your portfolio far more diversified. And here's the best part: what makes this even more powerful is that it's going right inside my tax-advantaged account. So, not only do I get the benefits of diversification and low cost, but I also avoid paying taxes on dividends or capital gains while my investment grows. This is perfect for a $5 per day challenge. Of course, it's crucial to remember that stocks can go up as well as down, and your capital is always at risk when investing. However, if you choose to invest in an index fund like the S&P 500, which tracks the performance of the top publicly traded companies in the United States, it's worth noting that historically, no one has lost money when they've bought and held for over 20 years. Past performance isn't a guarantee of future results, but long-term investing in diversified funds like this can significantly help reduce risk. Compared to individual stock picking on Trading to 112, I went to the Create a Pie option. A pie is just a fancy way of showing how your investments are divided. For example, if you had $100 and split it equally between for individual stocks, your pie would have 4 equal slices of 25% each. I chose the custom pie option and searched for a simple Vanguard S&P 500 index fund. You'll usually see 2 options for index funds, one with in brackets and one with DIS. It stands for accumulation, meaning all your dividends are automatically reinvested back into your investment. This is short for distribution, meaning you receive the dividends as cash. For this challenge, I wanted it to be as easy as possible, so I chose the accumulation option to automatically reinvest everything. Step 4. Setting up auto investing. The magic of dollar cost averaging. We've got the account set up, and we know what we're investing in. But now comes what many people imagine to be the tedious part: investing a $5 every single day. Honestly, I think a lot of the skepticism towards this challenge comes from people imagining the effort involved, but the truth is, it doesn't have to be hard at all. That's why step 4 is to set up auto investing. This feature isn't just great for the $5 challenge, it's essential for any investor, no matter how much you're putting in. This is because it takes your emotions out of investing and leverages the power of dollar cost averaging. Let me explain. The stock market is completely unpredictable. It doesn't just move in one direction. Sometimes it goes up, other days it moves sideways, and then there are times it goes down. When the market is down, your money actually buys more shares because prices are lower. For example, my $5 stretches further, letting me pick up more shares at a discount. And when the market is up, my $5 buys fewer shares because prices are higher. The idea is that over time, these ups and downs balance each other out. This is the magic of dollar cost averaging. It's been such a reliable and stress-free strategy for me because it removes the pressure of trying to time the market perfectly for this challenge. I use this exact strategy by investing the same amount every single day. If daily isn't feasible for you, investing monthly can yield similar results. It's entirely up to your preference. Back on Trading to 112, after selecting my S&P 500 fund, I click Next. This gave me the option to invest manually or use the Auto Invest feature. Of course, I chose Auto Invest. Then next, I set the initial deposit to £5. For the investment frequency, I selected daily, and for the amount, I again set it to £5. Finally, I set the duration to 1 year. Trading to 112 even has a cool value projection graph that shows you what you can expect to make in a year based on historical data. While £1,970 may not seem super impressive when you're putting in £1,800, if you slide that projection all the way to 40 years, you'll see how compound interest truly takes over. This projection suggests a £5 a day investment could be worth over £5.5 million from an investment of only £73,000. Of course, these are estimations, and no one knows what the market will do long term. But playing around with these projections is incredibly motivational. I then named my investment Coffee a Day and funded the pie using the free funds option, which takes cash from my balance on trading to 112. As long as I topped up the account every now and then. The daily investment went through automatically. I pressed confirm, and boom, it was all set up. So, a year from now, I said to myself, hope I'm still alive, and now, it's time to reveal the results. The results, a year of small habits, big returns, right? It's time to check out the results. I know I'm about 5 months late on this update, but that just goes to show how good the Auto Invest feature is. You literally forget it's investing in the background. But trust me, the results are worth the wait. They're genuinely interesting. I started this challenge back in August 2023. After the first month, I was up to £37, which was a 1.5% return. Not bad, but then September rolled around, and things didn't go quite so well. I was actually sitting at a loss of 79 pence, a minus 0.5% return. This right here is why so many people give up on investing. In the first 2 months, I had almost nothing to show for my consistency. It's no wonder people decide to pull their money out when they don't see immediate results. But I was determined to stick with my dollar cost averaging strategy. And I am so glad I did, because things really started to turn around. Fast forward 6 months, and I was up £83.70, which was an 18.2% return. Not too shabby at all. And then, by the 12-month mark, I made £161.34 in profit, with an 18.1% return. That's where the auto investing feature stopped for the challenge. But I've continued tracking the growth since then. Now, let's jump to today. This is where it gets a little bit crazy. In total, I've invested £1,505, but my investment is now sitting at £1,972. That means I've made a profit of £467.03, which, when converted to US dollars, works out to an incredible $576.59. That's a staggering 43.8% rate of return. This is undeniable proof that time in the market beats timing the market. If I had panicked and pulled my money out after losing a little in the second month, or if I had stopped the challenge altogether, I would never have reached this point. Even I couldn't have dreamt of results like this, and it's largely thanks to the wild year the stock market has had. However, it's important to note that these results are not typical, and past performance does not guarantee future results. The market can be volatile, and there will be ups and downs. But this challenge clearly demonstrates the power of consistent investing, especially with the right strategy. I'm actually thinking about continuing this challenge long term, just to see how much it could truly grow over years. If that's something you'd like to see, let me know in the comments below, and I'll definitely make another update video in the future. Ready to start your own financial journey? Remember, even small, consistent steps can lead to monumental results. Don't let skepticism hold you back from building your wealth.